Bank. And they will be discussing the financial life cycle of a doctor. Basically, they will provide us with recommendations regarding student loans, home loans, business banking, and investment management. Tonight, we have Naveed Ahmed, who is our Senior Director, Eric Peterson, our Account Executive, Stephen Frigo, our Relationship Manager, and Marina Tukanjian, our Wealth Manager. Stan?
Thank you, Dr. Kowalski. Good evening, everyone. Welcome to another webinar being presented by the California Society of Plastic Surgeons. Just a couple of housekeeping items this evening. So for your questions, please use the Q&A pod at the bottom of your screen. If you scroll, you should be able to activate that for your questions, because that makes it easier for the presenters and the moderator to see your questions and make sure they're all answered. If you use the chat box, we can answer those as well, but it's more difficult for us to see those right away. So please try to use the Q&A pod. This webinar is being recorded. So if you have colleagues who are unable to make tonight, the presentation tonight, please have them stay close with the CSPS website so that they can view the recorded sessions. And I'll turn it back to Dr. Kowalski.
So without further ado, why don't you go ahead, Naveed?
Great, thank you, Dr. Kowalski. I'm gonna share my screen here for our presentation. Can everyone see that okay?
Yes.
All right, great. So thank you everyone for joining. As Dr. Kowalski said, I'm joined here with a couple of my colleagues, and we picked these topics as we thought they would be most relevant to this audience. So just to give a brief background about the bank and myself, I've been with the bank for 10 years, and over the last 2 or 3 years, I've developed a really good relationship with Dr. Kowalski and the association. We've supported the organization via various sponsorships and dinners, and are very pleased to be among such a esteemed group of physicians. We will also be sponsoring the upcoming convention here in San Diego. And so we look forward to meeting you in person there as well. So a little bit about, sorry, my slide is acting funny here. So a little bit about the bank. You know, our clients are really our best advocates and the key driver to our growth and success. You know, just to give you a brief background, the organization was founded in 1985 as a small thrift company specializing in jumbo home loans. We're now a full service bank, and growth has mainly come from our clients asking us to help with their businesses, their nonprofits that they sit on, and their wealth management. The bank is headquartered in San Francisco, but we have offices throughout Southern and Northern California. We also have a presence in the East Coast and recently opened an office in Bellevue, Washington. All our bankers are well educated in all these markets. Handle clients in Northern California as well as Southern California. Any questions you have, I can certainly answer and service any need that you may have. Similar to the way you practice your profession, we believe in doing the right thing for our clients. We realize how busy you are, and our goal is to make banking simple and easy for you. We portray ourselves as a service firm that happens to be a bank. What this means to you is that you never have to dial a 1-800 number. You get individual concierge level service with a dedicated team built around you. To that effect, we're not compared to other banks when it comes to customer service or client satisfaction, but other service providers, as you can see on this list. Our clients are the ones who have been driving our success by doing more with us and referring other clients to us. One of the primary reasons our clients love us is the relationship that we've built with them. And as you can see on this slide, we take a very client-focused approach with the client being in the center. And we can handle all aspects of financial services, some of which we will discuss today. Again, keeping things simple is the primary goal. If a client has a need in a particular subject matter, I'm able to loop in the expert without them having to figure out who they need to contact for that need. The other reason clients like us is the relationships we built with them. Unlike other institutions, there's very little turnover at the bank. As I mentioned, I've been here 10 years. My colleagues on this call are very, very tenured as well. As your business grows, you're not transferred to other departments of the bank. The banker you have stays with you for life, which helps you. You don't have to re-explain your business or income or anything. You're not transitioned around. It's very, very high touch service. And from a employee at the bank, the bank is very entrepreneurial and empowers bankers to make the right decisions for their clients and the bank, unlike other institutions where there's a lot of hierarchies or silos between departments. We are now the 15th largest, actually the slide is a little dated. We're now the 15th largest bank in the country. So we have the services and the strength of a big bank, but the way we operate is a lot different, like a small community bank. Again, focus is on service. Even with the growth we've had, we've remained one of the strongest banks when it comes to asset quality. Since its inception, our total losses are less than 0.1%, whereas the banking industry, it's around 4 to 5% a year. So we believe in making good loans to good clients and not in the business of making risky loans and collecting on assets. So that was a quick overview of us as a bank. As I said, we'll touch on the topics that I stated earlier. But before we move on, wanted to see if there's any questions in particular about anything that I've covered so far.
At this point, I don't see any questions in the Q&A nor the chat.
Great. I will now turn it over to my colleague, Eric Peterson, who will talk about student loan debt. As a lot of you might know, student loan debt, keeps growing. It's now the second largest consumer debt in the country. And so Eric will talk more about how we can tackle that. Eric, over to you.
Perfect. Thank you, Naveed. All right, let me know if you can see that. Appreciate you having us on today. Very excited to be here. Student debt, as Naveed said, one of the largest debts across America. And student debt has always been a hot topic, but probably today more than ever. And I can imagine that most folks in this room are probably intimately familiar with it. At some point, you probably took out some loans, whether they've been paid off or they're still outstanding. Definitely a good thing to look at early. Given the rising cost of education across the board, student debt's pretty much unavoidable in the absence of grants, scholarships, or family help, especially when pursuing the medical field. There's an organization called the Education Data Initiative that compiles numbers on educational debt. And basically, the cost continues to rise. No one's surprised about that. But today, the average student loan is about $36,000 per borrower. Just back in 2006, it was only 18. So that number has nearly doubled in a very short amount of time. And I don't think that's going to change anytime soon. Those numbers are just going to keep going up. Those numbers jump substantially once we start talking about med school. Doctors do typically have some of the highest debt loads after graduation, just given the number of years that it takes to, one, earn your degree, and then two, wrap up residency and become fully accredited. When many of our parents attended college, this was not an issue, but it's become much more so today, whereas student debt will now oftentimes rival a down payment on a home, or in some parts of the country, an entire home purchase. So given these large numbers, student debt is something that should deserve your immediate attention. It's often, I think, in our human nature to postpone it. Once you graduate, many of the loans will either be set up on auto payment or kind of out of sight, out of mind. But one of the biggest mistakes we see a lot of our clients making is postponing looking at them and figuring out a way to get that debt handled. If they're set up on auto payment, oftentimes the minimum payment is not even covering the interest payment. So these debts continue to grow and grow. And so the point where the client looks at the debt, they could owe 50 or 100,000 more than when they graduated. Pretty much any financial planner you're going to meet with will let you know that this is something that should be addressed sooner than later. Luckily, for the past couple of years, we've been in a fairly low rate environment. So, rates weren't maybe the worst that they could be, but I'm sure everyone's following the news. We're seeing inflation, we're seeing rates rise. So all of these rates will continue to go forward. Best thing to do is, one, figure out what you owe and make a game plan from there. Biggest question you need to do is figure out, one, how much is actually owed and spread across how many providers. Two, is that loan a federal program or a private program? Federal loans will often have some benefits, such as forbearance that many of the loans have been in for the past 2 years, income-based repayment, possible forgiveness should that come down the road. Private loans, on the other hand, usually don't have any type of benefit and often come with a much higher rate. Next one to look at, and this is really something that's coming to the forefront now, is the rate fixed or is it variable? For the past couple of years, we haven't had any rate hikes, so the variable rate has actually turned out to be a pretty good option. But the Fed increased rates a couple of weeks ago and is likely to continue doing so over the next year or two, which could take those student loan rates that were at one point, fairly reasonable. They could become astronomical fairly quickly. Next big question: how long is the repayment? The longer the term, the lower the payment. That being said, the amount of interest you pay over the life of the loan with the longer term will be much greater. Again, all federal loans are continuing to be in forbearance until August 31st of 2022. The administration has extended that deadline several times over the past 2 years and very well may do so again. So just kind of pay attention to what's going on in the news and what's going on with your loans specifically. Once you are ready to tackle them and get that rate under control, what you'll want to do is definitely shop around. Several years ago, there was very few options. First Republic's done student loan refinancing for quite a few years now. But over probably the past 4 or 5, the number of options has grown exponentially. So definitely look around, see who's going to offer you the best rate. On top of that, are they more than just a lender, or is it actually going to be a partner for life? And that's where we really feel that First Republic can step in and offer much more than, for one, our rates are fantastic, but two, you're going to get much more than just a low rate on your student loan. And as Naveed touched on, we are a very hands-on private style bank, so looking to be your lending and banking partner for life. This next slide is going to outline just a couple different scenarios. And I think the common misconception is that there's not a big difference between, a 6% and a 3.5% loan. Truth is, when we're talking about numbers that are as large as med school debt, it actually makes a tremendous difference. So scenario one, we'll look at a $200,000 loan. Say the average federal rate is somewhere around 6% over 15 years. Total interest paid on that $200,000 is almost $104,000 in interest. Dropping that rate down to 3.5 and keeping the term the same will reduce total interest paid to $57,000 and change. So over the course of the loan, $46,430 is saved in interest just by reducing the rate. Second option is to reduce the term, which will then in turn reduce the interest paid over the life of the loan. So in our same example, the $200,000 loan at 6% over 10 years, total interest paid would be just north of $66,000. Dropping that rate down to 2.75 would reduce total interest paid to $28,986. In this example, this borrower is going to save $37,463 just by dropping the rate. In an ideal situation, you can drop the rate and the term. And so reducing the term down from 15 to 10, and then reducing the rate down from 6 to 2.75 will at the end of the day save you close to $75,000. So huge amount of savings and not a lot of effort to get there. So definitely something to keep in mind. And this is where First Republic really wants to step in and help. As I mentioned, for the past 5 or 6 years, we did a lot of student loan refinancing. About 2 years ago, we sunsetted that program and replaced it with our personal line of credit. Biggest difference being is because it's a line of credit, it opens up the door to more use cases. We were finding a lot of our borrowers had, one, either paid off their student debt, or two, just had other life expenses to pay for. And so that's where the line of credit came in. We still have a large number of borrowers using it to pay off student debt, which is a great use case. But now the use cases have been expanded to cover home improvements on your home, whether it's solar, landscaping, new kitchen, family planning. In vitro surrogacy has become a very popular use, as well as buying a car, refinancing a car. Many of you self-employed may have large tax bills that come due at the end of the year. Line of credit's a great option there, as well as paying for medical and dental procedures. So again, the rate's always going to be fixed, but there's just more options on what you can use it for. This next slide will kind of run through some of the features and benefits of the line. Like I said, refinancing existing debt is what a large number of our borrowers do, but we can also give you a line just for future access to capital. It's a revolving line, interest only for years 1 and 2, which is great, helps free up cash flow, but at the same time, you've locked in that rate. Our loans have no fees, whether they be prepayment or origination. The loan amounts are flexible, anywhere between $65,000 and $300,000. And as Naveed touched on earlier, you're always going to get a dedicated personal banker. So whatever it is you're looking for, we will be there to help. At the moment, these are the rates that we're offering on our line of credit. The shorter the term, the better the rate will be. The longer the term, the higher the rate will be. And then depending on the amount of banking you do with First Republic, we will vary the rates in between. Currently, the best rate we are going to offer is going to be 2 1/4, and that would be on our 7-year term. As I mentioned, as the term goes up, the rate will go up as well. So at the moment, our 15-year is at somewhere between 3.5 and 4.25. So lots of great options. Again, they're all fixed, which is huge in our rising rate environment. And what taking care of your student loans early does is sets you up for the next steps in life. You know, generally, once people get student loans figured out, they will then look to buy a home, and that's where I will let Stephen Frigo take over and kind of run through how that is looked at and best options for you. So in the meantime, if anyone has any questions, let me know. And thank you again for letting us join.
At this point, I still have no questions in the Q&A nor the chat.
Great, thanks all. Let me share my screen really quick. So hopefully you all can see my screen. If not, let me know. But as Eric mentioned, my name is Stephen. I've been a relationship manager here at First Republic. Been with the bank for almost 7 years now. And as Eric mentioned, kind of the next step in the financial life cycle, if you will, is buying a home. We all know how crazy the market is currently, with house prices hitting record highs, right? And with rates going up. So I think what Naveed touched on earlier is really important, and kind of what differentiates First Republic. When you speak to a relationship manager here, like myself at First Republic, you're not speaking to a loan officer. We take a much more consultative approach. And again, if you have any questions at the end of this, happy to answer those in the chat or chat one-on-one. But kind of just at a high level, the things we look for when talking a client or a prospect through the home buying process, or even the home refinance process, really comes down to a couple of characteristics from a qualifying standpoint. Fun little acronym so you can remember. We call it the four C's, right? So capacity, collateral, credit, character. And so capacity really demonstrates, I guess, your ability to repay the loan. I'll talk about that a little bit more. Collateral is the house or the property, where it's at. What kind of home is it? Condo, detached single family home. Credit, I think we're all familiar with, credit reports, credit scores, and, kind of the last and I would argue the most important factor here is character. Obviously you can have a great property, a great credit score, great income, but what pays us back as the bank, and that's our borrower. And like Naveen mentioned, we like to meet all of our borrowers. We have a relationship with all of our borrowers, so really getting to know the borrower, their needs, their goals, their objectives. A home loan can seem transactional, can seem very cut and dry, but we do our best to make sure it's a really consultative and relationship driven life cycle. And so I'll dig into that a little bit more. And so when it comes to qualifying for a home loan, kind of the biggest factor is your ability to repay the loan. That can go without saying. And the main driver of that is really your income. And so the way we kind of look at this is, what is the debt to income ratio? And simply put, if you take your monthly obligations relative to your monthly income, that'll give you a certain percentage. And that percentage really dictates the comfort level. It's one of the things that determines the comfort level of the bank ultimately lending you money, what your maximum borrowing power is going to be. And so the first factor of that equation, the debt, obviously the biggest chunk of that is going to be the home loan, the housing debt. And so the home loan with your property taxes, your insurance is typically the biggest chunk of that debt to income equation, right? I mean, obviously we're going to pull credit and try to understand more about your debt outside of the prospective home loan. So things like, do you have any car loans? Do you have student debt? Do you have a personal line of credit, credit card debt, et cetera? And so those are the things that we look at. Really everything you're paying each month that we're going to find on a credit report factors into this debt to income calculation, right? So things like groceries, gas money, we don't really take that into account. It's really, what are we going to find on the credit report, and what are your true monthly debts each month? And this slide, kind of talks about the second part of that equation, the income piece. And so, for most borrowers, that's probably going to be your base salary, which you get a pay stub for, and a W-2. And where First Republic, kind of differentiates ourselves, and I think Naveed touched on this too, is we tend to attract, in terms of our client makeup, a lot of entrepreneurs, a lot of physicians and folks who own their own business, because First Republic, unlike a lot of other institutions out there, we have the ability to, for lack of a better phrase, kind of peel back the onion, right? And see and understand how our clients are truly making money, right? So if there's no W-2 or wage income and they own their own business, sure, their tax returns might look a little bit different. But we take the time to understand, their business, to understand the true cash flow of what they're actually taking in on a year-over-year basis. Some banks will see, either low or no W-2 income, and it doesn't fit their proverbial box, and they move along. First Republic, it's quite the opposite. If you own your own business, or if you have different means of income, we take the time to fully understand that. And so, after all that being said, the debt relative to the income, we like to see this somewhere in the low 40s. In a perfect world, 20s, 30s, teens, but kind of the maximum we're comfortable with is kind of the low 40s. So, for example, if you're making $120,000 a year, that's $10,000 a month, right? So between your mortgage, your car loan, student loan, we really wouldn't want to see those monthly obligations exceed $4,000 a month. And so these are all good things to think about and to budget and to take into account when kind of figuring out how much you think you can afford in terms of a home. And so, I mean, obviously, kind of the the other component to this is saving for the down payment and having enough funds left over to move, to furnish the house, to fix up the house. And so, this post-loan liquidity slide, I would say is more so to protect the borrower than the bank, right? And so we do require and look for typically 12 to 24 months of mortgage payments to be kind of left over in cash after you pay the down payment, after you pay your closing costs. And really what that guideline, it's a little bit more conservative than most, but we really think about it this way, is if, the roof, God forbid, cracks or leaks, or, something happens with your job, or moving expenses were a lot more than you thought, you have that windfall to kind of fall back on. And so, post-loan liquidity along with debt to income ratio, pretty important to look at. Obviously, with student debt being at all-time highs, and the current environment that we're in, the biggest challenge that we're seeing with recent graduates, first-time home buyers, is saving for that down payment. It's a pretty daunting endeavor, but there are some ways to get creative. I mean, obviously, it's pretty simple from a high-level perspective, just saving and budgeting each month. But there are some things that folks don't think about, and you are able to get a little bit creative if the broader story makes sense. And so, if there is a 401k available, a lot of borrowers use this as an option to help out with the down payment. As this slide mentions here, gifts from a family are a common thing that we see, potentially buying a property with a partner or a co-borrower. And then this last bullet point, investments, retirement funds, typically you've done a really good job and you've worked hard saving those. We don't, encourage you to tap into those if you don't have to, but I mean, the reality is the reality, and you've worked hard to save that money. So, we kind of look at it again from a holistic point of view when it comes to the down payment. We're able to get a little bit flexible and allow gifts, allow unique structures of borrowing. And kind of thirdly here, the collateral, the property. A lot of, banks have different, approaches with this. First Republic, Naveed also alluded to this earlier. We have a very clean credit culture, and we're pretty well protected. So I think the average loan to value, so loan balance relative to the property's value at the bank, is somewhere in the low 60s. And so when it comes to buying a new home, generally speaking, First Republic will want to see the borrower come in with at least 20% down for the down payment. So what that means from a collateral or a loan to value standpoint is 80% loan to value or below is generally where the bank likes to be. That's where we feel where we're most protected. That way, if there is some sort of correction in home prices, that 80% loan to value protects not only the bank, but you as the borrower as well. And this outline here demonstrates if you were buying a home of 750, what loan amount would equate to an 80% loan to value, 90% loan to value, 10% down, 97% loan to value, 3% down. There are some banks who may do that, but the way we kind of look at it is, especially in this rising rate environment, the higher the loan amount, inevitably the more interest you're going to end up paying over the life of the loan. And so to protect the bank, to minimize your interest expense, all the above, we definitely encourage a higher down payment than probably most lenders. And that also ties into how we price and give rates on our home loans. So the two main factors we take into account when pricing out a home loan are one, the down payment. So the larger the down payment, the lower the interest rate. And two, it's the bread and butter of the bank, which is really the banking relationship. So the more you do with First Republic in terms of having your online banking here, your business banking here, auto pay, direct deposit, the more that we can do as relationship managers to help, bring down the interest rate on the home loan. And so we talked about income, we talked about savings, we talked about collateral. Credit is the last piece to the puzzle here. I think we're all familiar, at a high level with the concept of building credit. But for a lot of our first-time home buyers who may have not owned a home before, credit will really kind of paint the picture of your borrowing history to the bank, right? So, have you taken debt on in the past? Have you paid it back? Have you paid it back on time? Have you missed payments? And so generally speaking, most banks will look for a credit score of above 720. That's kind of our approach. And, kind of a helpful, not hint, but fact is you can actually obtain a free copy of your credit report, I believe annually, through annualcreditreport.com. And so it's something that I do encourage, folks to do before going through the pre-approval process to have an idea of where they stand. And then this is kind of the, part of the consultative aspect, like I addressed earlier. Most people, when they call me for a home loan, they say, hey, what's your 30-year fixed rate, right? Mom got a 30-year fixed, grandma got a 30-year fixed, dad got a 30-year fixed. And most people don't understand there are more options out there. I'm not going to dive too deep into it in the interest of time, but kind of in this rising rate environment, would encourage you to explore what's called a hybrid ARM, a hybrid adjustable rate mortgage. It's the middle bullet point here where it says 3-1, 5-1, 7-1, or 10-1 ARM. So these are all still 30-year loans, but only fixed for 3, 5, 7, and 10 years, respectively. So, if you're buying your first home, the reality is you're probably not going to hold a loan for 3 years. In fact, we see folks on average either refinancing the property or selling the property within 4.5 years. And so, kind of the benefit of these hybrid adjustable rate mortgages is the rates typically more favorable than the 30-year fixed. The downside obviously is once they do pass that 3-year, 5-year, 7-year, or 10-year point, they do go adjustable each month. And so if you're going to have the property for 30 years, it may not be a good option. If hey, look, it's a starter home, we're going to sell this property, take the equity, buy our dream home in 5-10 years from now, would highly encourage you to inquire about these options, and I'm happy to speak further individually as well. And then kind of just last thing here is costs associated with a mortgage. If you're a first-time home buyer, First Republic at the moment is covering a lot of these for you up to $4,000 at the moment. And so, these are things that within the first, couple of days of you applying for the loan, your relationship manager is going to outline to you, what the estimated costs of obtaining a loan are going to be. So I'm not going to spend too much time on that. And then, lastly, this is my last point, is kind of, how we look at the whole process of getting pre-approved, then processing, then closing your loan. First Republic, one of our 8 core values is move forward, move fast. So a lot of banks out there will take days or weeks to complete a pre-approval. The good news about First Republic is Naveed, Eric, myself, Marina, the credit approving folks, our loan processing folks, we're all in the same office, in some cases the same floor. And what that really means is when you're going through the credit and the pre-approval process, I'm not getting your file, and it's not going to somewhere outside of the US or at a non-First Republic location. All the underwriting, all the decision-making is being made in-house. And that's pretty unique in the banking world. So definitely something where we're adding some value because we kind of understand the client's full picture, and we're able to collaborate internally as well. And from a home buying process perspective and a refinancing your home perspective, that's a very high level overview. Again, happy to answer any more detailed questions either in the chat or over the phone. And thanks again for the time. I think I'm going to turn it back to Stan for a Q&A if there is any, and then off to Naveed.
At this time, we still have no Q&A entries, nor do we have a chat entry.
Great, thank you. Naveed, I'm gonna take it away.
All right, thanks, Stephen. Right. So kind of the next topic we thought would be of interest would be business banking. Say, you've bought your home, paid off your student debt, or maybe they're running simultaneously, and you decide you want to, start your own practice. So, the first thing I think that comes to mind when looking at business banking is your money safe, right? Like you're working hard to make your money, and so you want to bank at an institution that is safe. So the things to look for there is credit rating, asset quality, reputation, capital ratio, things that I first touched upon. We're in the business of making strong loans. We have a strong balance sheet. We've been in business 35 plus years. And from a deposit standpoint, treasury management standpoint, we kind of cater the banking to your need. But one of the main things that is important in business banking is what's called an earnings credit. And now an earnings credit is a credit you receive on the deposits you keep, used to offset any banking costs. So your wire costs, ACH costs, remote deposit costs. And so our earnings credit is probably the highest in the banking industry at 1%. Other institutions are typically at 0.25%. What that means is on the balances you keep, you get a 1% credit, and that 1% credit you can use to offset any costs. This page, I know there's a lot of information here, but again, this is we customize the treasury management, the banking services based on your needs. Our corporate online profile is very simple to use. You can set up wires and send wires yourself through our corporate online profile. You can limit access to certain individuals where they are not able to see balances but can transact. We also have some clients who want their CPAs to have the ability to go in and download statements for tax purposes. So again, very customizable to your banking needs. The remote deposit capture machine, what that is a machine that we set at your office. If you receive a lot of checks, you can scan through those checks through that machine. If you get, say, 100 checks, just run them through the scanner. It uploads it directly to your corporate online profile. We on wires, we don't charge for incoming wires. A lot of banks charge on incoming wires. And again, for outbound wires, you can set it up yourself, or you can email our client service team and they take care of it for you. One additional benefit that we've recently started is a cybersecurity, where as a complimentary service, we can offer a cybersecurity health checkup, for your, whether it's personal or business practice. It's complimentary, no cost to you. From a lending standpoint, there's a lot of different lending needs that may come up through the life of a doctor, whether it's buying a piece of equipment, buying real estate, line of credit, letter of credit. So I'll briefly touch upon, the different financing solutions for most practices. A line of credit is basically used to bridge short-term financing gaps. So for example, if you're a surgeon and you get a lot of money through insurance, and the insurance company takes 90 days or so to pay you, you would use a line of credit to bridge that gap. So if you bill the insurance company day one, but they didn't pay you till day 90, and you have, multiple such instances, and you need to pay your employees, then you would tap into a line of credit to bridge that gap. And as soon as the insurance money comes in, you would then pay the line off. And it's a revolving line, which means it's kind of like a credit card. You use it when you want, you pay it down. It's always there. Line of credits are variable rate loans, and they're interest only. So what that means is every month, if you have an outstanding balance, you only pay interest on that balance. You're not required to pay principal. But for most lines of credits at most banks, you are required to pay it down to zero for 30 days during the life cycle of a 12-month line of credit. This is to make sure that you're not using it for, something that it's not meant for example, equipment purchase. And this is essentially done to protect both you and the bank. As I said, it's a variable rate product. So if you do end up buying a piece of equipment through a line of credit, and it's a variable rate loan, and the rates keep increasing, then your monthly payment will keep increasing, and you're not going to pay down the equipment loan as quickly as you thought you would. So, pivoting to term loans, that is the product that's typically chosen for, longer term use cases, such as equipment purchase, making improvements to your property, if you're acquiring another practice, those kind of things are more fall under the term loans. And what term loans are, they're fixed rate loans, which means you get certainty of your monthly payment. It won't change during the life of the loan. And similar to what Stephen had mentioned, you can choose between 3, 5, and 7 years, and they pay off to zero, based on the term you choose, whether it's 3, 5, or 7. Again, as the longer the term, the higher the rate, but lower the payment. So based on your budgeting and cash flow, we would discuss, the right kind of product for you. Next topic would be, commercial real estate. A lot of businesses want to buy a property to occupy. It has a lot of tax benefits. Also, you get a lot of control over the property you're occupying. Unlike home loans, commercial loans for owner-occupied businesses require 30% down. Home loans are traded much more than commercial loans, and so therefore a higher level of down payment is required on commercial loans. Typically, most borrowers would create a LLC to hold title to the property. And this just adds another layer of protection, and then have a lease with their own business to this LLC. However, from an underwriting perspective, banks will look at the business operations, since the operations are dependent upon the ability for the business to pay the LLC rents. Banks like to generally see a debt service coverage ratio of 1.25. What a debt service coverage ratio is similar to debt to income ratio that Stephen mentioned. Debt service coverage ratio, for every dollar of debt, the business needs to show $1.25 in profit. For example, if there was a $5 million loan, and we assume, just for ease of numbers, that the principal and interest payments are $100,000 for the year for that loan, the bank would want to see $125,000 of income on average, which is the 1.25 ratio. One thing to keep in mind when looking at purchasing commercial real estate is prepayment penalties. What prepayment penalty means is that you're not allowed to make additional payments on your loan. This is basically, a lot of banks want to guarantee a stream of interest income from you, and so they prevent you from paying the loan down aggressively. Some banks have complicated prepayment structures, whether it's a swap agreement, yield maintenance. We like to keep things pretty simple. We don't do complicated structures. Our prepayment penalty is very easy to understand, and it goes away after a couple of years. The other thing that Stephen had also mentioned, home loan rates are usually fixed for 30 years. But commercial loans are not typically fixed for 30 years. Typically, they're fixed for the longest term would be 10 years. And again, this is because unlike home loans, commercial loans are not sold to Fannie Mae and Freddie Mac. So banks carry this debt on their balance sheet and don't want to lock in rates for a long time should market conditions change. You might think that this is bad, but similar to home loans, we found that borrowers typically transact again on an average in 8 years' time, whether it's to cash out their equity, to use the money for something else, or rates generally fall. And so they want to refinance and take advantage of the lower rate. So it tends to be beneficial for both parties. We also, we do commercial real estate for businesses. We also do commercial loans as investments. A lot of clients like to buy commercial property as investment property, apartment buildings, strip malls, office buildings. These are more specific to the property, the types of tenants, strength of the lease of those tenants. We won't get too much into that topic since it's probably not relevant to most people, but happy to answer any questions should there be any questions on that topic. Some of the other loan programs that we've seen people utilize relates to startups and or new businesses. There are plenty of programs available for people looking to start a practice or acquire a practice. Banks typically, shy away from those types of loans. Banks like to see a history of operations or a good amount of capital injection from the borrower. We partner with the CDC Small Business Finance, who can offer solutions for people looking for such financing with startup, when they're in kind of startup stage. There are a number of programs available through the CDC for startups. There's another program, which is, there's two main programs that the SBA offers, which is the SBA 7A and the SBA 504. The 7A is more for startup businesses, and generally, those loans are often higher priced than banks, and the underwriting the underwriting requirements are more lenient. The 7A is for new businesses and startups, but they oftentimes would take a lien on your primary residence. At First Republic, we don't originate those loans, but we refer our clients to partners should there be an interest in their program. The other SBA program is the 504 program. This is used to acquire real estate to be occupied by the business. Unlike the traditional commercial loan that I mentioned, which requires 30% down, with the SBA 504 program, the borrower only puts 10% down. The bank would do a 50% loan, the SBA would do a 40% loan, and the borrower would do a 10% loan. Would inject 10% of capital. Like I mentioned, owning real estate has a lot of advantages from a tax standpoint. So that would be something that you would want to consult with your CPA should you be in the market or considering purchasing a property for a practice. The other advantage of the 504 is that the 40% piece that the SBA does is actually fixed for 25 years since it's a government bond, whereas the bank portion is fixed for a maximum of 10 years. The disadvantage of the SBA 504 is that there are additional costs involved, and sometimes the process can be lengthy. Oftentimes we have clients that are looking to refinance properties, and what we do as a service is kind of do an analysis for them to see if the refinance is beneficial, since a refinance does come with transaction costs that need to be paid. These are appraisals, title, escrow, and then if you have a prepayment penalty, you would have to factor that in. Unlike home loans, commercial appraisals cost a lot more, and understanding the total cost involved is an important element when considering a refinance. So that was basically, high level overview of business banking and lending. Happy to answer any specific questions anyone has on business lending.
At this time, please use the Q&A feature at the bottom of your screen. If you just scroll down, you will see Q&A, and if you open that up, you can type your questions in.
All right, I'll turn it over now to my colleague, Marina, who's going to talk about our last topic, which is wealth management. This is basically how you can manage your wealth as you're working and building up your balance sheet, as well as planning for retirement, succession planning, financial planning. So Marina, take it away.
Wonderful. Thank you so much. Let me get my screen ready here. Can you see my screen okay? Wonderful. Thank you, everybody. I'm a wealth manager here in San Diego. Pleasure to be here with you tonight. By way of background, I have been in the financial services industry for 27 years, 17 years of which I've been in wealth management. I've been with First Republic for 3 years now. As a wealth manager, my role is to help our clients plan for and achieve financial independence. This slide here does provide some insight on our depth of resources and capabilities here at First Republic. Typically, we start an engagement with our comprehensive financial planning process. This is our first step because it gives us an opportunity to listen and learn about what you envision financial independence to be. It's not only about learning the quantitative figures of your current financial situation, like how much is in your investment account or what are the terms of your mortgage, but it's also learning about, what's important to you. What concerns do you have? What's keeping you up at night? And what your major goals and priorities are with the money that you have, the wealth that you have created. And with that information, we then study, stress test, analyze, and develop solutions to help achieve as many of those priorities as possible, with taking as little risk in your investment strategy by backing into the most appropriate asset allocation to help you get there. And once the initial findings of the plan have been presented, and that's typically when we have a deeper discussion about our investment management capabilities to make sure that your portfolio is aligned with the work that we just completed and reviewed. And if it isn't, that's when we would make recommendations on how we would reposition your assets to align with your income needs and risk tolerance, and recommend the most cost-effective solutions available. Another cornerstone of our wealth management trust and estate is trust and estate planning. And as a resident of California, our limit here to avoid probate is $150,000. So we want to make sure that you have foundational estate documents in place to avoid the expensive probate process and the very public probate process, and make sure that your wishes will be honored when the transfer of wealth takes place. It's also making sure that you have a financial power of attorney document in place, a healthcare power of attorney document in place, a living will, so that there's no disruption in making sure that your financial needs and healthcare needs are being addressed. And the most important action to take once you have established a trust is to make sure that your assets are registered in the trust. We also use this opportunity to review your beneficiary designations on your retirement accounts and other assets that would pass on by contract, such as life insurance contracts or annuities. First Republic Trust Company does have the expertise and the fiduciary capacity to act as a corporate trustee in the event that you don't have a trusted individual to help facilitate the estate settlement of your trust. Another core component of our wealth management is risk management. And risk management consists of making sure that not only all the gaps in your financial plan are being addressed, whether it's making sure that you don't have a running out of money situation during retirement, or it could even be finding ways to mitigate estate taxes. We have subject matter experts available to help find solutions based on your situation, whether it is for estate planning or life insurance, disability, long-term care, or even in a business capacity with buy-sell agreements. And regarding long-term care insurance, for most individuals that are over 65 years old, unfortunately, about 70% of those individuals will experience a long-term care event during their lifetime. And an average term for that long-term care event is typically 3 years. And down here in San Diego, the average cost of care for long-term care services at a reasonable facility is about $7,000 a month. And with healthcare expenses typically rising higher than the cost of traditional inflation, that can quickly derail a financial plan if there hasn't been anything planned for should an event like that happen. So that's part of just, a brief overview of our holistic approach to wealth management. And as part of being, on your team as a wealth manager, the first 2 steps were identifying what's important to you, listening and learning essentially that process, stress testing and developing a strategy to move forward. The 3rd step would be to look at implementing that plan. And the 4th step is, I'm sorry, my dog. And the 4th step is the 4th step is the monitoring process. So it's, financial plans are not just one and done here. Our plans are very dynamic. So as life events happen, we typically use that as a decision-making tool too, whether it's, should I buy this car with cash or finance some. Once a financial plan is established, we're able to use that as a decision-making tool relatively quickly by figuring out how those different toggles would impact the success of your plan. And so that's where that deliver and review is always there. That monitoring will continue on. As part of our retirement plan services that we have here at First Republic too, I wanted to share that for our business owners, doctors, lawyers, so forth. We have retirement plan consulting team here to where whether or not you're currently or you currently have a plan in place or you are looking to establish one, to be able to help save for the future, have more tax mitigation, in terms of, reducing your tax liability by sheltering some of the income that you've earned with your practice. We're able to help design and provide you some solutions based on what your objectives are to not only, save for the future, but hopefully attract and retain talent as well. So that's a complimentary service that I'd like to share with you too. But that's pretty much all I wanted to cover today. If there's any questions, happy to address them.
And I still have no open questions in the Q&A, nor in the chat.
Okay, thank you.
Dr. Kowalski, I think you're on mute.
I'd like to thank everybody tonight. This was a very informative discussion, and I hope that our members gain some information from you. And is there, how can they get a hold of you, Naveed? Can you give them that information?
Sure, we'll circulate contact info to Stan, who maybe can pass it on.
That'd be great. Well, thank you again, and good night, everybody.